We saw signs of a rebound on Friday, as we noticed green right across the board. But still, when we look over the week as a whole, we are noticing pretty much strong red in nearly every single industry. And that is the same to be said when we zoom out over the last month. And the same when we look at a year-to-date perspective. The market in 2025 hasn't been that great, especially for the Max 7. The one analyst who continues to say that every dip should be bought is Tom Lee, who we see at the beginning of February. When we did get the initial dip, he said the S&P is gonna go much higher into 2026. And this is something he continues to say, as we do notice the dips fall further and further. And even at the beginning of this month, he said that a lot of bad news is already priced into the market, and now is a great opportunity to buy what he believes is the market bottom. And he also is someone who expects the S&P to have quite a rocky ride. In 2025, he believes by the middle of the year, we will see around 7,000 points, but does ultimately see this retrace around 6,600. Meaning for 2025, he estimates the S&P have a 9% return. And in fact, in his own opinion, he believes the market was bottoming last week, and he believes there are very high that we are gonna get the 10 best days in the market very soon, and believes the markets right now are oversold and pessimistic. And this is something we can confirm, as investor sentiment is very low right now, sitting in extreme fear at 21. With investors worrying about the short term, they're worrying about tariffs, about Donald Trump in power for the next 4 years, as well as many other factors, which will ultimately affect the wider economy, and there in turn the overall stock market. We also know the S&P 500 for the first 100 days in office has actually had the worst performance under Trump's tenure. This year with Biden in 21, Trump himself in 2017, and Obama in 2013, all showing very strong signs of the market. But again, this is very short term. We could be in for a much better performance moving forwards. And when we go back to 1981 and look at the present and the reflective S&P 500 price return, we can see there was only one president which during their whole tenure returned negative performance, and that was George Bush Jr. in both his respective terms, 2001, 2005 with Donald Trump in 2017, noting around a 70% performance. Now again, this is too early to see how the markets are gonna go. The odds and probability are in his favor. And even with the drops we have been seeing in the market, the S&P overall, the valuation of 28 on a price to equity and we can see the mean and the median sitting around the 15 to 16 region. So whilst you may believe just because we are seeing a correction, stocks will go up, we do want to point out that historically they have traded at a much lower valuation even after all the drops that we have seen. Just here today, companies are trading at very high forward pace, and this is in comparison not only against the historical figures, but also against their own averages. The S&P also entered into a correction territory, which only took 16 days, and this is effectively when we do notice a 10% drop. And one factor bear in mind is that it only took 16 sessions for the S&P to sink down 10%, and also 3 of the 7 fastest drawdowns have actually been under Donald Trump's tenure, 2018, 2020, and now in 2025. However, one thing we do want to make clear is that corrections are fairly normal, and we actually notice at least one every year when we look at a more severe correction, which is determined as 15% more of a drop. That is one every 2 years with a bear market. More than a 20% overall drop one every 3 years. So again, whether you like to play the probabilities or not, we could now be looking at a potential bottom, but we could also be heading into a severe correction, which is once every 2 years, and as noted, a bear market once every 3. For those that also like to look at the performance on a sector-by-sector basis, you could argue there is some possible market rotation. We notice information technology and consumer discretionary are down significantly. Double digits, the S&P down -6%. They are lagging, whilst we're seeing defensive sectors outperforming, like healthcare, which is up for 0.3%. Another noticeable trend that we is the valuation gap between European stocks and US stocks. Also, it was very high over the last year. We're noticing now the difference in the forward compressing, and this is something we haven't in quite some time. Also, not the best news for investors, but bond markets at the moment are outperforming the stock market overall. As we said S&P down 6.1%. The US bond index currently sitting up to 0.3. And all of this does mean that traders are getting about worried where the stock market is heading next. And they're all keeping eyes on the liquidity, whether it's coming into the market or whether it's starting to retrace. And the key reason for this, as noted, is a lack of liquidity in the previous crisis has tended to intensify any of the market moves. So we do anticipate more volatility to continue into the week now. We're looking at some of Tom Lee's favorite stocks that he has mentioned that he does believe to be undervalued in this market correction. And the first one is none other than the semiconductor giant Nvidia. Now they are up around 38% over the last year. Year to date, they have suffered down nearly 10%. And just over the last week, they have started to recover that equal amount. But over the last month, they have ended into a downtrend, negative 11% while around the midpoint of the 52-week range. A strong buy signal from Wall Street and a buy from Seeking Alpha. And they do also pay dividends, although fairly trivial at 0.03%. We also just want to flag their latest earnings, where from the previous quarter, their revenue is up 12%. In fact, data centers, which has been the main driver of their income stream, up 16%, and their margins are very impressive at 73% gross margin, 61 operating, and 56 bottom line. As we will come to show they massively outperform the sector as a whole. And maybe unsurprisingly over the next 4 quarters, they do anticipate double-digit growth to the EPS with a 100% track record and anticipating for $50 to the Jan 2026 earnings per share, meaning they're trading at a valuation on a forward basis of 27.01. And we also want to point out, this company does trade well below their 5-year average. P40 to 0.9 right now, 27.3. And this is what we would call a severe undervaluation signal. We also want to point out, we'll highlight it through our own valuation model, that this company, again, looks to be severely undervalued, as the blue tunnel here reflective of the fair price. And the current trading price does it massively below. A lot of disparity that, again, severe undervaluation. But we typically don't tend to look at any model in pure isolation. And we can see here, once they get an F on the grading, they do trade above the sector at 22. You are paying a 25% but premium. As we will come to show you on other metrics, there are much higher than the sector. So a premium is well deserved. But as we've just flagged, they do trade lower than their 5-year average of 48. At a discount of 44%, something that we can see no matter what valuation metric you look at today. They trade at a massive premium to the overall sector. Actually a discount to the historical figures, with growth looking strong. And a year-on-year revenue triple-digit growth 140%. Forward-looking 61%. Well above the sector at the mid-single digit. Also above their own 5-year at 64 and 39%. Respectively, so Nvidia, a company grown their revenue incredibly fast, even faster than their own 5-year average, does now trade significantly lower than what they have historically. That is definitely something to take note of. And they anticipate EPS growth of 33% over the next years above the sector, significantly of 15%, above their own 5-year as well of 27.7. And then when we do flank their profitability, very strong at a plus gross margin 75%, well above the sector of 50, well above their own 5-year of 6. Bottom line 56%, again well above sector of 4, above their own 5-year. So not only are they trading at a price that is lower than their 5-year average, so more attractive, but also growing revenue faster and improving on their efficiencies. We also noticed cash flow operations at $64 billion, well above their own 5-year at 15.7, but also well above the sector at $105 million. Now our intrinsic value today comes to $162, derived from the DCF where we have the free cash flow year on year. We have the latest 2025 figure, where they've grown it 153% over the last 5 years. Year on year 100 for over the last 10. Now, whilst we have gone for a growth rate of 20%, you can see low, medium, and high 2025 numbers, as always, are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or the any 20% growth rate, 8% discount giving us rate, the present value of future free cash flows. Terminal value add together with the subtract cash. Total debt, get to the equity value divided by the shares outstanding 6.2, meaning 30% upside, but as as we'll show you at the 15%. For those that believe 20 is too optimistic, $115 meaning downside of 5%. And for those that are a lot more bullish, at the 25% growth rate moving forward, $227 indicating 88% upside. As always on this channel, we do take through the medium rate of 20%. We're not just done because we like to apply a margin of safety 10%. We execute on that if it meets our 3 golden criteria: wide, most strong financial metrics, good forward-looking data. If you believe that a buy around $146, then we keep going till it's near the current trading price. And ultimately, on today's episode, what we're effectively saying for the AI giant, you're getting a 25% months with Wall Street themselves, seeing $177 price target over the next year. Translating to 47%. As always though, do give us your thoughts about these stocks today. Now, we also want to let you know, we do release a free weekly article every single Monday morning to your inbox, where we cover severely undervalued stocks, as well as what's going on the market over the last few days. So, click below and you can sign up and read straight away, where you'll also be able to get access to severely undervalued stocks for the month of March. Lots of information for each one, including the upside that Wall Street themselves over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stop we're moving on to is Alphabet, which is up 16% over the last year and year to date. Down 13% just in the last week. Pretty much flat, although over the last month down 11%. If you've been a shareholder over the last 10 years, massive outperformers of the S&P, up 476%. Although right now trading near 52-week low, with a double buy from Seeking Alpha and Wall Street, and a yield that is payable around 0.48%. We also noticed from their most recent double-digit growth to their revenue. We noticed double-digit growth to their ad revenue and 13% increase to their search advertising, which has come under fire. Yet they are still growing it at a very impressive rate, also improving on their margins. We're seeing efficiency, gross margin up 1 percentage point year on year, operating up 5, and bottom line net income up 4%. Their future earnings expectations also looks very strong growth for with a 100% historical track record. And right now, with an EPS estimate of $9, they're trading at a forward valuation of $18.43. Now, when we compare that to their 5-year average, it's significantly lower. Again, meaning severe undervaluation, and that is also confirmed. When we do take a look at this model, it does sit below even the expected rate at the bottom, and again, we're seeing a lot of severe undervaluation, not just with Nvidia, but also with Alphabet. Yet when we look at their grading, it does come in at an F, because it is trading at a premium to the overall sector at 41%. But as we just highlighted, it does trade at a discount around 27%. Their own 5-year average. Their growth looks strong though at a year-on-year up 14%, forward looking up 12%, well significantly higher than the sector, in the low single digit, but slightly below their own historical figures of 18 and 15%, with the expectation of growth at 17% to the EPS, well above the sector at 12, but pretty much in line with their own 5-year at 17.9. If we were then to turn to the profitability at NA, 58% gross margin above the sector at 53, above their 5-year at 56. Bottom line 29% again, above both sector at 4 and their own 5-year. So improvements are noted to their margins, whilst also generating a whopping $125 billion cash from operations, significantly above their own 5-year average of $87 and significantly billion higher than the sector. At $366 million, our intrinsic value comes to $226 as you can today. See again a low, medium, and high. We have gone for 12% the medium, and again, rate. This does have quite a significant margin of safety, especially with all of the bearish sentiment around this company. You could perhaps want a larger months. Now, you're not getting 30%, but you are getting at least 25% up to $170. With Wall Street seeing this at $220 over the next year, translating to 33% upside. What we can also do for Alphabet at the lower end, for those who want to be a bit more conservative, what the margin of safety is, because you will still get given the disparity between the two figures. At 10%, it's a buy around 177. At 20%, around 157. Not so there yet. So you are getting at least 15% on a future future growth rate around 10% for the longer term. Again, Wall Street's price target does remain at $220. The next stock is Meta Platforms, which is up 24% over the last year and year to date. Over the last week. Flat over the last month, down 17%. But similar to Nvidia, similar to Alphabet. Massive outpour of the S&P up 625%. And I'm sure some people were buying this towards the lows in October 22nd at $91 right now. Trading in the mid to upfront of the 52-week range. A strong buy from Wall Street. A buy from Seeking Alpha. And the yield payable of 0.35%. We also noticed their most recent earnings. Top line was up 21% year on year. And we can in fact see we notice margin efficiency. But quite significant one on the operating side. Up 7 percentage points and their bottom line up 8. They do, however, anticipate only 3 of the next 4 quarters to have growth. Also maintaining a 100% historical track record. And trading at a forward P sitting around 24. Make it the second cheapest in the Max 7. Based on this valuation metric, we do have to point out historically, this company hasn't traded at severe high numbers. Around 23.3, so based on we would say reasonable valuation. And this is confirmed when we look at this model. As in fact, we can see it is sitting in the midpoint of the blue tunnel. And remember, we always want to see this increase over time, as ultimately that is what you want from any company you're invested in, and they also, like the previous two, didn't get the best valuation grade. In fact, in comparison to the sector, they're trading at a premium of 84%. And as we just showed you, they're trading at a very marginal to 0.15% premium. Their own 5-year number in terms of growth, get a B minus, very strong 22% year on year. 17% forward looking, well above the median low single digit, but also slightly above their 5-year of 19 and not far off the forward looking of 17.1, with EPS expected to grow at 18% in line with their own 5-year average, but above the sector at 12.4. Profitability coming in strong, adding a plus gross margin 82% above sector 53, above their own 5-year of and 81. Bottom line 38%, well above the sector 4, well above their own 5-year average. As we showed you earlier, bottom line net income did have some great efficiencies, and cash from operations 91 billion, nearly double from their 5-year average of 56 and significantly higher than the sector comparable at 366 million. Now our intrinsic value today comes at just under $700. Where we've gone for a 10% growth rate. We have used the low end, but as you can see, 12, 14. So based on our low end of 10% to the free cash flow growth, you are still getting a margin of safety at 10%. Buy at 630 at 15%. Pretty much around where the company is. Not that far off, so for Meta Platforms, we see a near 15% month, with Wall Street themselves seeing this at $765 over the next year, translating to 26% upside. We then move on to another semiconductor giant, Asm, which is down 26% over the last year, up the 3% year to date on the week, up 3% and over the last month, and down but 8% over the last 10 years like the previous companies. Today, massive outperformance of the S&P up 531%, trading near its 52-week low. A double buy from Seeking Alpha and Wall Street, and a yield payable of 0.73%. We also noticed a massive growth on a comparison to their sales at 28%, with some nice efficiencies on the operating profit, but still even on their bottom line, their margins are very impressive, as we will come to show you. And in essence, the company does anticipate 3 of the next 4 quarters to be growth. Although bear in mind, semiconductor industry is fairly cyclical, and we can see a 100% historical track record, currently trading at a forward valuation around to 7 to 8, pretty much in line with Nvidia. Now, one thing we would say though is this company, very similar to Nvidia, does trade significantly below its own 5-year average. For that is a potential severe undervaluation signal, and that again is confirmed, as there is disparity to where this company sits and the lower end of the intrinsic price, and another F on the evaluation. Something we noticed with these companies, but again, they are high quality, so they probably do deserve the premium. In fact, when you compare you're paying a 27% premium to the overall sector, comparison to their own 5-year, you are getting a 31% discount in terms of growth. At a C+, not as impressive as the previous 3% year on year, 10% moving forward. Sector, not far off on both accounts in the mid-single digit. Over the last 5 years, they have grown at a much faster double-digit rate, with EPS anticipated to come in at 19.4%. That is lower, although not far off their 5-year at 22.4. But they are above the sector at 14.8. And finally, profitability. Add in a plus gross margin 51% above the sector, above their own 5-year of 50 bottom as well. Line 27% well above the sector but of we 4. Do notice pretty much in line with their historical figures. But one thing this company has significantly improved is their cash from operations, 12 billion, with their comparison at 8 over the last and also 5. Well above the sector median at 105 million. Intrinsic value today comes to $1,055. As you can see, we've got the medium rate of 14%. And we will also show you at the lower rate. Going with that medium rate for now. 10% months a buy at 9.4. 9 at 20% again a bite at for 3. 8. And what we are noticing with ASML, you're getting at least a 30% months up to 7. 3.8 at the 35% point. You would have to wait for 6. 6, something we just saw over the last few weeks. But right now, minimum 30% months. Wall Street themselves see this at 9. Over the next year, 32% upside. But as we mentioned, we'll show you, for those that believe, we should be a little bit more conservative. At the 12% you are still getting a margin of safety. And in fact, we can show you today, you are getting at least 20% up to 3.6. And for 25%, you would have to wait around 90 6. As always, do you give us your thoughts about these for stocks? Do you see them as a buy, hold, or and sell? And don't forget to sign up to the free weekly grab those spreadsheets, come and join us in a Patreon where we cover our weekly buys and sells. As always, have a great day. We'll see you all on the next one.